Let's begin with the presentation, and we're going to look at how do you use derivatives in managing portfolio losses. So that's the basic idea. There is an appendix at the back on futures. If you are sort of new to derivatives, options and futures, it may require you to catch up on some of the material, but that can be done later. As you'll see in this presentation, the applications are not all that sophisticated, but nonetheless, it does require the use of options and futures in risk management. All right. And so the agenda for this presentation is issues about loss mitigation. We've talked about loss aversion over risk aversion, and the idea that people are much more scared of unexpected losses than unexpected gains. No one feels bad about unexpected gains like winning a lottery ticket. It's the large surprise losses that is scary, which needs management. So like your house or your life, all right, you insure it because you don't want any unexpected losses. Say a flood comes or a fire and destroys your house, or you have a premature, you die prematurely. Those are unexpected losses of wealth and income, and you want to mitigate those losses. So you transfer the risk to an insurance company. So if you think about it, portfolios are of equal importance to at least houses and stuff. Definitely not for life, but for the income replacing your life income. Portfolio values are oftentimes equal, if not bigger. So why don't we insure them? So that's what we're going to talk about. We'll look at some introductory loss management schemes and advanced schemes, and then we'll conclude. All right. So insurance is, the basic idea for insurance is pure risk, right? And you want to transfer that risk to a company which will sell protection to you and take your risk from you. So that's the basic idea in insurance. And insurance is a discipline on its own, and it is separate from investments. But just like insurance exists for all our different things of value, in investments too, we have portfolios which are of value, and we need the same protection. However, we can't use the term insurance because it's an insurance industry and not an investment industry product. So what we're going to look at today is how you can use investment products for the same purpose. Like insurance, you can't really call it insurance because of the legal issues around the term. So in investments, we call it hedging or risk management. But underlying it is the same idea that you are mitigating loss or managing loss. Used to be that portfolio insurance used to be thought of as something like a program trading computer-based issue, and that came about with the 1987 crash. On that Black Monday, when the market dropped 25% on a single day, after that many people blamed program trading and portfolio insurance, and that's a different meaning than the insurance that we're going to see today. That meaning was much more about models, quantitative models, numbers models, where programs would determine different price levels and set of trades whenever market levels hit certain thresholds. And so many people started thinking that portfolio insurance is about program trading. What you're going to see in this presentation has got nothing to do with program trading and everything to do with mitigating loss in portfolios. So that's a main difference out here. Now, if you look at this graph, you'll see that the horizontal line represents the time, but also in this case, we are using that to show what an expected return from some investment may be. So let's say if you expect to make 10% on your portfolio over the next 20 years or 6% on your portfolio. So that's the expected return. The actual return is the line that goes through, and you can see the actual results are different from the expected, and we've talked about that. These are the surprises. All right, when it departs slightly, it's a small shock, when it departs greatly, it's a big shock, unexpected shock. And then, the stats come in as which departure or divergence from the mean is significant at the 95% confidence interval. So from that, you can understand why we use standard deviation. If you think about these lines out here, say the unexpected returns, and I've got these three arrows. If you look at that, that's x actual minus expected return. Both the greens and the reds are actual values minus the expected values. That's the amount of dispersion or deviation from the mean. When we square these amounts, and I'm sure you remember with Tom when you did it, you square these amounts, add them up, and then find the square root, you get standard deviation. So that's why standard deviation is an appropriate measure of risk. And you square them at first and add them up so that the negatives and the positives aren't washed away. If you just added them up without squaring it, you wouldn't get a true picture of how volatile something is. All right, that's why you square them up. And in this picture, you can see clearly how standard deviation is a proxy for risk. Okay, unexpected gains, unexpected losses. And the whole issue about loss management versus risk management, when you manage risk, you manage both the unexpected gains and the losses. That's what risk management is. And that comes about from risk aversion, because we are averse to risk. That's the understanding behind risk aversion. And the theory of risk is that we don't like unexpected gains and unexpected losses. But when you ask someone, do you not like unexpected gains? I mean, everyone will laugh at you, right? Because that's a rhetoric and not a question. No one minds an unexpected gain, like a lottery or your stock. You buy a stock at $8, it goes up to $90. You're thinking it would go up to $12, and you'd make 50%, and it went up to $90. Are you going to be sad because it was risky for you? So much volatility? No. We are concerned about unexpected losses and loss aversion. So you can see the whole avenue with coming from behavioral finance is that our focus should be on loss aversion and not risk aversion. However, the models we use, modern portfolio theory, is based on a normal distribution where you need the mean and the standard deviation, and which is all you need in a normal distribution. But once you bring in standard deviation, you're bringing in unexpected gains and losses. So when you manage risk, you're managing also your unexpected gains and losses. We would much rather not manage unexpected gains, but just manage unexpected losses, which is the idea of insurance. From the risk management perspective, the typical scenario, the way we think of risk management in a portfolio is simple diversification. And this picture shows you the impact of diversification. So if you were to invest in US stocks, domestic stocks only, you can see if you put together a portfolio, well-diversified portfolio across all industries, all right? There's no concentration of industry in your portfolio. If you diversify across all portfolios, all industries, you will, by the time you've hit about 40 stocks, most of the non-systematic risk, which is the diversifiable risk, has been diversified away. After that, adding more stocks does not reduce the volatility of the portfolio. Whatever's left over is the market risk or the systematic risk of the US market. And since the US market is one of many global markets, you are now exposed to the diversifiable or the unsystematic risk of the US market, which now can be diversified away if you add international stocks. And if you have a group of, say, 40 large cap global stocks representing the 11 different industrial sectors, then you've essentially got yourself a very well diversified mutual fund. All right, and you can see that's all you need is 40 stocks from a variety of well diversified holdings across industries and sectors. That's all you need to diversify all the risk. And you can see by doing this, you've diversified the risk of global economic markets down to a 0.12 standard deviation. So that's the basic sort of foundation of risk management coming from the investment viewpoint. But this will take care of both upside of risk and downside of risk, and we know we are interested more in the unexpected losses than unexpected gains. So when you diversify, when you manage risk up and downside, if you look at that yellow line, you take away the extreme edges of the actuals. You are smoothing out what the actuals will do. That's what diversification does. It takes out the extremes, it reduces the volatility so that your days and nights are much sounder. When you get your monthly statement, you don't get a fear or you don't get euphoric because the markets last month treated you very poorly or very well. You know beforehand that your portfolio value will not fluctuate by great amounts because of the risk management that you have in place through diversification. Now, loss aversion tells us that we are not averse to unexpected gains, we are averse to unexpected losses, and that's what we want to manage. And so what we want to do is to manage the downside of risk. So this presentation is about that. How do you manage the downside of risk, or how do you insure your losses on your wealth, whether it's your house or your car or whatever, that's your wealth, and you want to manage the downside. So when you get auto insurance, it's for accidents and stuff like that, which is your loss. You know, if your car drives for 300,000 miles without any problem, you don't want to insure against that, right? That I don't want to have a great time with this car. I just want to have be sure that if I do get into an accident, that I'm protected and I'm not liable for large losses. So the same thing we are going to use for our portfolios. So think about the insurance principle, and I'm not going to go much into it because you are students and at this point experts in this field. So insuring, what you do, you transfer the possibility of pure loss, which is your policy. You pay a cost, or what you call the premium, to buy protection against the loss. Each policy has a term, a 6-month policy, 1-year policy. And that's the maturity of the policy. Then you decide on how much protection. Do you want face value, or do you want to have it under or over insured? And the way you do it is like you use deductibles. So for example, when you have your house, let's say your house is worth, say, $350,000. You can insure it for $350,000, which is face value, or you can underinsure or overinsure. Similarly with your auto insurance, you can underinsure by saying, I want a big deductible. So when you want a big deductible, you do that because you want to reduce your premium, right? So the premium is what you are sort of looking at to manage. If the risk is large and you want to insure the whole thing, your premium is going to be large too. So then in this case, you can ask yourself, can I keep some of the risk to myself so I don't have to give the whole risk to the insurance company, and in return I will pay a lower premium? So how much protection depends on how much of the risk you want to transfer. So if you have a very, very low deductible, you're transferring all the risk, but your premium is going to be very high. If you underinsure your house, let's say your house is worth $400,000 and you insure it for $300,000. You've underinsured it for $100,000. Of course, your premium is going to be down, but if there's a damage to your house for $100,000, then that full damage is yours because you've underinsured. On the other hand, if you overinsure, you pay higher premium, but if the house burns down, you will rebuild a grander house, and that's the idea of overinsurance. The same thing will happen with investments, but in this case, we're going to look at options and futures rather than insurance products. If you look at this, this table, you can see a one-on-one comparison between insurance and investment hedging using put options. And it's a one-to-one correspondence, absolute mapping, that a put option or even a call option, as you'll see, is exactly the same as an insurance policy. No difference, and that's why they were invented. Unfortunately, they've been abused because they are so good for speculation and gambling. They are very leveraged products. They're very good for speculation and gambling, and and the media loves when people use it for speculation and gambling and blows up all the money. So that's why most of the media reports have been about the abuses of hedging using derivatives rather than the uses. But if you really think about it, these products were invented for risk management and hedging, and not for speculation and gambling. But they were discovered by gamblers and speculators who have given them a bad name, and most people just hate to even think about having options and futures because they sound like voodoo items and so on. All right, if you look at it, in the case of insurance, you have a premium for your policy. In the case of options, you also have a premium. It's also called a premium. It's exactly one-on-one. When you think about the value of the asset, like your home or the present value of your life income, that's the value of the insurance policy asset on which the asset and insurance is written. In the case of the investment scenario, we think of that as the index level. So today the S&P 500 is at 1250. That's the face value of the large cap section of your portfolio. So that's the index level. That's what you want to protect. You can underprotect, overprotect, or protect at par or face value. So we use the index level as how much you're protecting. The face value of the policy is the same as the option strike price. How much of the risk are you transferring? Are you insuring the whole portfolio, or are you insuring part of the portfolio? That determines what the option strike price is and what's the face value of the policy. The amount of deductible tells you how much of the risk you're keeping for yourself, how much you are transferring. In the case of options, it's choosing a strike price. If you choose out of the money options, then that's like higher deductibles, keeping risk for myself, lowering my premium. If you get an in the money option, then you're over insuring, higher premiums. If you're at the money, then it's as face value. If your house is worth 400,000 and you insure it for 400,000, that's like the same as putting together an insurance policy on the face value of the option, and you're buying at the money option. So if the index today is at 1257 and you get a put option or a call option with a strike price of 1257, same price as the index, then that's face value or full value of the asset. That's what you're protecting. Finally, duration is like, if it's a 1-year policy, you get a 1-year index option, and that works like that. If it's a 6-month policy, you get a 6-month index option. In the OTC, over-the-counter market, you can write longer policies which have more than 1 year. You might have 2 years of time, but let's not get into that. In the case of options, you have leaps which go beyond 1 year, long-term options which can go 18 months, and in the OTC markets, sometimes even up to 5 years. All right. But the main point here is that it's a one-on-one mapping between put options and insurance. All right. All right. In terms of strategy, and we won't go too much into that because that will take a whole bunch of time. I will sort of gloss over it, but I'm happy to send you this presentation for you later on, and you can go into it. You won't need my input. You can read it and say, all right, I understand what it is, once we understand what the main results are. But the inputs to the decision of insuring is no different than when you insure your house or your life or your car. How much does it cost? How much risk is there? Specific market opinion. I mean, what's the chances that am I in a flood zone or am I in a fire zone? Similarly, in portfolios, you want to start with asking, what's the risk of a market correction? With this Greece thing or the unemployment thing or the manufacturer's purchase thing, is there a possibility that the market can move up and down? And if it moves up, what's the chances it'll be moving up by more than 10% in the next 90 days or 15% in the next 90 days? What's the chances it'll move down in 15% in the next 90 days? That's what you want to protect against. That's what you want to insure against. What if there's an unexpected down movement in the market and your portfolio loses 15%? that means a large amount of change in wealth for the client. So you must have an opinion about what you expect in the future, and we've talked a lot about expectations, right? So you know, as an advisor, you are going to form expectations. And when you form expectations, you are going to take action. Similarly with portfolios and portfolio insurance. If you think that there's going to be a big correction, if you have expectations, you need to take some action. Right now, our hands are tied if we don't understand hedging. What do? We just have to have a diversified portfolio and leave it at that, right? That's the only choice we have right now if we didn't use derivatives. But what I want to show you is that yes, you do have a choice, and this is how it's done. You know, the large mutual fund guys, you know, who manage global portfolios, whether it's large cap or international. If you go in and look at their annual reports, you'll oftentimes see the derivatives usage. Say global strategies will have foreign exchange options and so on, and or they may not have options if the company is you know, like say treasury bonds. They may not have options because it's covenanted by the company that no options can be used by this mutual fund. If such a covenant does not exist, then most mutual fund managers will use some kind of derivatives, options or futures to manage the risk of unexpected corrections. And typically it will be unexpected corrections, which is about loss management and not risk management. So the expectations, the number 3 out here, specific market opinion, becomes central to your action. All right, and we understand that, and which is wonderful for me because I don't have to explain how expectations drive economic actions. And then the time frame of the strategy. What's the time frame? 1 year, 3 months? How long is this correction going to last? So the natural question could be that you are expecting, say, about a 15% decline in the Dow Jones over the next 90-day period. And you might want to ask yourself, how reasonable is that expectation? How often does the Dow Jones drop by, say, 12% or 15% over a 90-day period? And if it does not happen very frequently, if it's a very rare event, then you might say there might be something wrong with my expectations because I don't have those kinds of data right now to form it. So the first thing to do is to check whether the Dow Jones does dip by these large numbers often enough, frequently enough, so that you can actually, you know, say, yeah, I think this time also it's going to drop by a large amount, and therefore I need some protection against that. So in this case, we also need to understand that, and of course covered inside that is the volatility issue, and we've been looking at that as you know, if our expectations are wrong, then markets are going to be volatile because they're going to be surprises. So the whole idea about volatility comes from our expectations and also because of leverage, because when we are looking at volatility, it means risk, and risk is also the same as leverage. All right. Okay, so this is between 1969 and 1988. Number of days the Dow Jones declined by huge numbers, all right, or number of times. But that was long time ago. So let's look at a more recent study, and I did this study to catch up. So this is from January 1989 through 2006. And the lower lines on the top and bottom, the yellow and white lines, the lower ones show how many times it went above 12% in a 90-day period or below 12% in a 90-day period. And the outside boundary shows how many times it went plus minus 15%. And this table is a better rendition, though you can see from this chart that it's not infrequent. That's what you can see with, you know, eyeball it, and you'll see that it's not that infrequent. It's actually quite frequent. And this table shows you how frequent it is. And it charts for you how many times it went up and down by greater than 12%. And you can see in this time period of 18 years, 17, 18 years, over in a 90-day period, there were 72 times when the Dow Jones had a correction upward of 12% or more, and 30 times a downward correction of 12% and more. But even more telling is the average change per correction on an up and down side. And you can see the average change on a downside is 22% as compared to a 20% upside. So the average dip is much steeper than the average spike up. And you can see that an average change of 22% would be of concern to any advisor. And 30 instances in 17, 18 years is about 1.5 times a year that we are getting a correction in the market. So that's not a small number. 1.5 times a year in a 90-day period, you are having a correction of 12 to 15%. And this definitely requires us to understand whether we can manage this risk or not. I mean, think from your client's side. Imagine what happens whenever they see something like this. So the very important assumption is your expectations, and I will gloss over it because in this case you understand why it's important, your expectations. But we're expecting a correction in the near term, 3 to 6 months, of about 12 to 15%. And let's say the S&P 100 index, not the 500, but the 100 largest firms, the index is at 255. We use the 100 because these mutual fund managers like the S&P 100 over the S&P 500 because it's the 100 largest firms, and it gives, whenever you're managing large caps, you would want to use S&P 100. If you were using, if you have a diversified portfolio, small caps, large caps, or whatever, domestic, then you would probably use the Wilshire 5000. That's much more appropriate for a total return on stocks than the S&P 100. But if you're managing large caps, then the S&P 100 is the index of choice. And in this case, let's say the market declines 15% over the next 90 days, which means it's going to go down from 255 to 216.75. All right. So that's a 15% decline, and that is your expectation. And since you expect this significant decline, you want to take some action, right? That's the logic that we have understood in economic decision making. Expectations, action, and then actuals, and then surprise or not. If you're right, no surprise. If you're wrong, there's surprises. But in this case, what we are saying is we don't want nasty surprises only. We don't want the downside surprises. We want to keep the upside surprise absolutely open. Let's assume we have a portfolio of $10 million and it's very close to the market portfolio because it's all large caps. So if you have the 100 largest stocks, you'll probably have a portfolio which has a beta of 1. So that's the same out here, all right? It's a large cap portfolio, very much like the market portfolio. If it's a bit off, then it gets a bit more complicated because you have to get into hedge ratios and stuff. Again, that's more advanced investments, and we won't get into that. All right, now we're going to look at 3 strategies. Buying a portfolio equivalent of at-the-money index calls. Strategy 1 is fully insuring your portfolio. If your house is worth $400,000, you want to insure it for $400,000. In the case of the portfolio, if the index level is 255, then your strike price has to be 255. Okay, that's the option equivalent of insurance that you're going to buy. The strike price will be at the money, which means it will be the same as the current spot market index level. Strategy 2 is going to be similar to strategy 1 in the sense that whatever number of contracts you are buying in strategy 1, you will buy the same number of contracts in strategy 2, but in this case, you're going to keep a deductible for yourself. You're going to keep some risk for yourself. So in this case, you will not buy index call options at the money, but you will buy them out of the money. So if 255 was the at the money strike, when you buy a strike price of say 260 or 265 or 270, then it's out of the money call option. Premiums are much lower, but if let's say you got a 270 strike price and the market moves from 255 to 270, you will not get any benefit from that because you're out of the money and you've kept that risk for yourself, that if you're wrong, a partial amount of your incorrectness, you will have to bear the cost. So while everyone else will benefit from the market going up from 255 to 270, you will not. But if it goes above that, you will benefit. In return, if the market actually goes down, your premium in strategy 2 is much lower than your premium in strategy 1. Okay, so that's the idea, that if your expectation's right, then this is a much cheaper insurance policy. But if it's wrong, you're willing to take a part of the cost in the upfront, but after that, you are still insured. Portfolio 3 is a bit more complex, and I won't go too much into it, but it's called a straddle. A straddle is when you are trading on volatility, and in this case, strategy 3 is similar to strategy 1 in the sense that whatever it's costing you to implement strategy 1, you will spend the same money in strategy 3. And whatever is the strike price for strategy 2 will be the strike price for strategy 3. So strategy 3 is a combination of strategy 1 and 2. Okay? Strategy 3 is the same dollar value as strategy 1 and the same strike price as strategy 2. Alright, we call this the 90-10 strategy. Alright, in the 90-10 strategy, you're insuring the downside of your portfolio. You're hedging your portfolio using call options. And this is sort of a basic strategy, and later on, as you'll see, it's nothing different than an indexed annuity, but in this case, you're doing it yourself. You've got an indexed annuity where if the market falls, you get the your losses are insured. If the market goes up, you'll participate on the upside, but your downside is protected. However, indexed annuities often get bundled in with all sorts of other nasty goods. There are commissions and fees. There's none of this out here. It's a do-it-yourself strategy, so it's absolutely cost-free and free for you to transfer and pass the benefits to your clients. All right? Now, 90% of the money or more will go into treasury bills or money market funds, right? T-bills or money market funds. 90% will go into, let's say, money market funds, and only 10% will be used to buy options, or 10% or less, as you'll see. So in this case, if you think about it, that's my portfolio. Let's say I've got just a stock portfolio. Let's not think about diversified portfolios. I've just got a stock portfolio. Or think about the stock portion of your portfolio. Think of that as the 100% that you're managing, because the stock parts are typically the riskiest parts. So you might be just managing the riskiest portion of your portfolio. That's the 100% we are managing. Now, 90% of that is in money market funds. So the first thing you'll note is that, well, I can't lose on the money market funds. I'll make a very low return, but I'm going to come out with 90% and maybe a bit more. If the interest rate is 3%, then I'll come out with 2.7, 92.7% at the end of the year. If my option is lost, I can only lose 7.3%. If I've got 3% return on my 90%, then at the end of the year, I have 92.7% in that account. And if the option has become worthless at that time, then I have only lost 7.3%. So the first thing to note is that you can lose, the maximum in this case you can lose is the 10% minus the rate of return on the money market rate. So you can see how you've already managed your losses. And on the upside, you'll see how the call will work in a moment. Second, as I said, is a low-cost participation with some risk. And third is a more hybrid, a slightly more sophisticated technique. Let's say we are given these strike prices and these option premiums. All right. So the current market level is 255. So if you want to fully insure your portfolio, then that would be the strike price. And each option, within each option contract, the option premium is $12.125. For the index, S&P 100 index, it needs to be multiplied by $100 to get the value of one contract. So if it's 12.125 multiply by 100, you get $1,212.50 is the price of one contract. All right, that's the price of one contract. If you go out of the money, and you can see 260, 265, 270, the premium goes down. Okay, so that's the first thing to note out here. Now, if you look at the bottom of the table, the question that's being answered there is, how many contracts do you need to buy to fully hedge a $10 million portfolio? All right, that's the idea. How much hedging protection do you need if you have to be fully insured? So the appropriate calculation is divide your 10 million by the strike price times 100. 100 is the multiplier on the S&P 100 index and the S&P 500 index. It's the multiplier. So if you divide 10 million by 255 times 100, it gives you an answer rounded up to 392, actually rounded down to 392. So you have to buy 392 at the money call options. All right. So let's see where this gets us. So in this example, if you buy 392 call options, each contract is worth $1,212.50. You will spend $441,000 for those option contracts. Multiply 392 by 1,212.50, you'll get 441,000, which is 4.41% of 10 million. And that's your policy premium. That's how much you're going to pay. That's your maximum loss in this portfolio. During this year, whether the S&P drops 500 points or 50,000 points or 5 points, your losses cannot be more than 4.41. It's insured at that. If the market goes up, you will participate in the gain minus your 4.41%. So for example, if the market goes up 10.4%, you will make 6%. If the market goes up 20%, you will make 15.6%. So subtract 4.41 on the upside, that's your return. So whatever the market makes, you will make minus the premium for your policy. It's as simple as that. Really simple. So now you can see it's not only 10 million, but actually you're going to invest 9.5 million. There might be a slight error in this number, but it will be somewhere around 9.5 million you will invest in money market that you cannot lose. All right. So let's see how that works. So now this is an example of what might happen in the next 90 days. All right. First of all, there's some calculation issues out here, but nonetheless, generally everything is absolutely all right. In this case, actually, you're going to spend, it should be 441, but there might be a calculation issue. It could be 475 too. So you spend 475,000 on your options, not 441, but actually, no, it is 475, which means you have 9,524. $9,524,000 to be invested in treasury bills or money market. And let's say the money market is offering 7% or treasury bills are offering 7% a year. It might seem too high to you right now, but if you go back to 1998, 1999, it was around 8%, 9%. Today it's very low, but it will go up again. It does not matter what the rates are because you're going to put 95% of your money in the money market. Even if it earns 1%, it's going to reduce your premium by a certain amount. In this example, it's going to reduce your amount. So if you put 9.5 million at 7% risk-free for 3 months, it'll earn $166,683. And so therefore, at 255, look at the table at 255, if you add 166,000 to 9.5 million, you'll get 9.691 million. All right. So at this point, 9.691 million. If the market doesn't change in the next 90 days, then you will have lost 9.7, about 0.3%, 3% or 3.1%. So in this example, your option premium is what it costs you. The money market rate is what you earn. The difference between the two is your maximum loss. So if you are spending 4.75% on your insurance and you are receiving 1.6% on interest, the difference 3.1% is your maximum loss. So if your expectations were correct and the market started going down in the next 90 days, it goes down from 255 to 240 to 225. Let's say it goes down to 210, close to your 15% expectation. No matter what, if your direction of your expectation is correct, if you were correct in your expectation that the market's going to have a correction, then your maximum loss is going to be 3.1% no matter what. You are insured on the downside. Absolutely insured. What about the upside? What if the market goes up to 270? That's about a 6% increase. In this case, your at-the-money call options will gain value because call options may gain value when the market goes up, and the two together will give you an increase in your portfolio value of 2.8%. 10.28 million it will become. And if you see the difference between the market increase and your portfolio increase, market increased by 5.9, yours increased by 2.8. That's because you paid 3.1% as your insurance policy premium. So on the upside, your participation is equal to the market's minus your premium, which is 3.1%. So market goes up 23.5, you should make 20.4, which is what you see. So full participation on the upside and insurance of your losses on the downside. Strategy 2 and 3 we have explained, out of the money calls and a combination of strategy 1 and 2. So insurance with a bigger deductible, so lower cost. In this case, instead of paying 4.75%, you're only going to pay 1.96%. So you've lowered your premium by keeping some of the risk, and the risk is if the market goes up to 270, that's like your $100,000 undervaluing of your home. If you undervalue your home $100,000 and the fire destroy is worth $100,000, then you're going to take the whole loss. So if the index goes up to 270, that's your worst case because you've lost 5.9% increase on the market plus the 1.96% premium. That's like your deductible working against you in this case. All right. So that's the issue there. So similar to 1, but on the downside, if the market goes down, your losses are going to be a lot less. But if the market goes up, you're going to have slightly higher losses. But then as it keeps going up, it won't be as good as the first policy because on the upside, your difference between the market increase and your increase is going to be that 7.8% or 9% because you took some risk and you kept some risk for yourself, and this is your cost because you were wrong in your expectations. You thought the market would go down, but you're not sure. You kept some risk for yourself, and it's going to cost you. Strategy 3 is a mixture of strategy 2 and 1. First is that just like, it shouldn't be 441, it should be 472, but whatever you spent in strategy 1, you spend in strategy 3. But you're going to buy at the same strike price as strategy 2, which has a lower premium. So therefore, if you buy at a lower premium but use the same money as strategy 1, you will get many more contracts. So in this case, the premium was $500 per contract, so you will get 882 contracts in strategy 3. And you'll see what happens here. And again, the maximum loss and gain are shown, but this is a better table to show each of those, strategy 1, 2, and 3. So strategy 1 we've already looked at. On the downside, if you're right, your insurance value is 3.1%. That's the maximum loss. So this is loss aversion management. You can tell your client up front, you cannot lose more than this. It's predictable, just like your insurance. You know if your home burns down, you haven't lost anything. Is there anything unknown about it? The only thing unknown is how good is your underwriter. If it's a AIG and they were let to go down, then it could be a problem. But there's no other problem other than that. If a fire burned to your house, you're going to recoup your losses. Same thing out here. If the portfolio insurance, if the market goes down, your portfolio, you've already paid insurance on your portfolio of 3.1%, that's all you lose. You can't lose anymore. You already paid up front. So you can predict what the outcomes will be on the downside, and you can equally well predict on the upside. Just think about the magic if you could predict for sure what's going to happen. This is like that. I don't want to use the word guarantee because it's sort of like a no-no word in the industry, but it is what it is. Insurance is a guarantee. So is this, because it's just like insurance. It's a guarantee that this is going to happen. If the market goes up, you'll make money. Look at the strategy 2. You've reduced your insurance because of the premium, so it's much lower till 255. If you were right and the market went down, your insurance cost is very low. It only cost you $200,000. That's the maximum you could lose. But now if it goes up, then let's say it goes up to 270. This is your worst case. So in this case, you've lost 6.1%, bigger than any other strategy. So that's the biggest downside on this, is that if you're wrong and you've underinsured, and that's what it did, that it destroyed your house worth $100,000, which is the same as going from 255 to 270. After that, you're insured. If the house burns down to 100,000, you're going to get still 200,000, even though you are underinsured it. So you're protected on the upside beyond the strike price of the out of the money call. So if it goes up to 285, open unhedged is 11.5. Strategy 1, it was minus 3.1%, and in strategy 2, it's 5.6%. You're giving up about 6.1%. That's the total cost on the upside. So you're going to perform much lower than the market if your expectations are wrong, but if your expectations are right, you're going to look beautiful to your clients. That's all I can say. Your clients are going to kiss your hands because you saved them, and for cheap too. But if they're not willing to take that risk, and you've got to point it out that, look, if I'm wrong and you're wrong, this might happen, then you better fully insure your house. And you can use those examples of insuring your house. That's the exact same situation. So if you don't want to keep that risk that when everyone's benefiting you are not, like say at 270, then you better fully insure. But after that, you will get the benefits of the market. If the market goes up 23.5%, you will have a fairly significant upside potential, and your downside losses are very well contained. Finally, in strategy 3, it's a bit strange. It's called a straddle. You can see on the downside, it's the same as strategy 1 till 255, and then strategy 2 till 270 because it's out of the money call. So this is the worst case. If it goes up to 270, then you are out 9% in strategy 3. Then you are out 9%. That's the worst case scenario for strategy 3. But look what happens when the market when you're wrong and you're very wrong. You thought it was going to go down and it actually goes up a lot. So in this case, if the market goes up 11.5% to 285, strategy 1 made 8.7%. Actually, you'll start going exponentially on strategy 3. You'll make 11.2%. If this market goes up 17.6, you've made 25.4. If the market goes up 23.5, you have made actually 40%. So it's not being subtracted anymore. Those premiums are getting doubled and being added. And it's called a straddle because you're playing on volatility in this case. You are taking the risk on volatility. If it's volatile and you are right, you will make money. If it's not volatile, you'll lose money. But again, you won't lose more than 3.1% because you have that insurance on the downside. So that's the basic idea here. And let me go quickly. Here, strategy 1, 2, and 3 are represented in this picture as strategies 3, 4, and 5, not 1, 2, and 3, okay? Strategy 1 and 2 are using futures and cash. So we won't get into stock index futures or selling your portfolio. So that's strategy 1. If you expect a correction, that's always the case. You can sell the portfolio and hold cash for 90 days. You are fully protected for 90 days. But if you're wrong, you're going to get nothing from the upside. Whereas strategies in this example 3, 4, 5 or 1, 2, and 3 in our example before, you will make money even if you're wrong. You're protected on the upside too. You'll participate on the upside but have limited losses on the downside. So number 3 here is strategy 1. Your maximum loss is 3.1%, and on the upside after 255 it goes up. The difference between 3 and unhedged is simply 3.1%. Whatever the market does on the upside, you'll make 3.1% less. Strategy 2 has a bigger deductible, so a slightly bigger chance of loss, 6% if you're wrong, 6.1% we saw. But on the upside, you'll get in the money much quicker because you paid a lower premium. And strategy 3, this is the combination, is a straddle. That's a play on volatility. That if markets really go down, you'll actually make out like a bandit. Just like on the upside, you will get protected at 3.1%. Okay, so that's the basic idea on portfolio risk management and insurance. Now, you can see in this grid, I have put together the strategies. When do you use strategy 1, 2, 3? And remember the sort of decision variables. What's the cost? What's the risk? What's your expectation? What's your benefit that you expect from your strategy? What's the time frame? How volatile is the market? How often should you be using the strategies? You can read it, and as I said earlier, you will understand this. You don't need me to explain each of these in detail, and I can send you that stuff. All right. All right, one last strategy and then we'll close for discussion. It's called a collar. When you are sort of sitting on the fence, you don't know whether to get in or not. And your experience has been, the moment I get in, everyone's getting in and making money right now. But the moment I get in, it might reverse and I'll take a loss. And it happens a lot of the time. When do I go in? Because it's so uncertain. That's why it's called the fence strategy, because you're sitting on the fence, but in a technical term, it's called a collar. And in a collar, I'm going to again gloss over this part. What you do is you buy a call option. Let's say the index value, fully insured, is 240 or 241. Portfolio is 10 million. You buy at the money call option, buy at the money call option, and you find out how many contracts, just the way we did before. Divide 10 million by 240 times 100. And this is the price per unit. Multiply this by 100. And then you'll find that the total cost of the call option is $346,000. And at the same time, sell the same number of options as what you bought. So sell 414 call options, but at a different strike price, out of the money. So the price is lower, and since you're the writer of the option or the seller of the option, you will receive this $207,000. So the net cost of your strategy is 1.45% or 145,000. So the net cost of this strategy is 145,000. And this is what would happen in the table, and I'll rather look at the chart, much easier. It shows you the collar. Collar means you have a floor and a ceiling. And in this case, you're reducing your cost by selling calls. And so what it means is that when you reduce your cost, you're basically putting a maximum on how much you can earn as well. So the upside, in the previous example, you had unlimited upside in strategy 1 and 2 and 3. That whatever the market did, you got the same minus your premium. In this case, it's not, because of the way you've structured it. You've got a floor, which is the maximum you can lose on the downside, and you've got a ceiling, which is the maximum you'll gain on the upside if you were wrong. So you expect the market to go down, but you're not sure, it could go up. So I've bounded both sides. These are also called bull spreads, bear spreads, other names for it, but the typical name is a collar, where you have a floor and a ceiling. So in this example, if you did that, this is when you don't know what to do. Your maximum loss is going to be 1.45% and your maximum gain is going to be about 3%. So when everything is uncertain, this is a good way to participate in the market without exposing yourself. The long, LIP means long put, SIC means short call, and then the asset of which you're valuing is what DEP is out in this case. Can you use it? How do people use it? So this is where collar investing fits. Bond managers, equity managers, they can both become collar investment managers, and they can all use collars instead. And here's an example of an actual situation where a collar would have paid off. And these opportunities arise all the time. You just have to know the calculations and find out whether such an opportunity exists. In this case, this is Google on the 18th of September 2007. The stock price was trading at $526. A put price with a strike of 520 was trading at $56, and a call trading at 590 was trading at 56.50. So you buy the put, sell the call, that's your collar, and in this case your net cost is 20 cents credit to you. Because you receive 56.50, you spend 56.30, so it's actually not even zero cost opportunity. It's a positive. You're actually going to get paid for this opportunity. And in this example, over the year, if the market went down, your maximum loss was going to be 0.8%. That's the red part. That's the maximum you could have lost. And maximum loss was 1.1%. And the maximum gain could have been 12.2%. In this example, actually, the gain was 9.1% during this time. If you had lost, if you were wrong and Google went down, you would have lost 0.8%. So the collar floor is negative 0.8% and the ceiling was 9.1%. So collar is an appropriate way to invest when you are unsure, but you want to limit your downside risk. And in return for reducing the cost of limiting your downside risk, you are clipping your upside gain, and which is the collar part. You got a ceiling too. And the reason you have a ceiling is because you want to reduce the cost of this strategy. And you're willing to give up the unlimited upside in return for a lower cost of controlling your downside. And that's what a collar works. I won't get into this example. And these are, again, when you read it, you can see when are collars suitable, and middle income investors is a great place where you can do this. So that's a way, and you can see buyers of products that offer downside protection, equity linked CDs, guaranteed annuities, structured notes, non-taxable accounts, and all these separate accounts, and all they can all use it. And collars or 90-10 strategy is much superior to money market strategy. Alright, so we insure everything, why not real estate? Alright, I'm going to stop sharing and I'm going to quickly show you the results that are of a test we did, and it's one of the students in this class who helped me do it, to show you how amazing the results look like in actual stuff. So you can say, hey, this is theoretical, it doesn't work really. So to sort of give you evidence that that's not true, I want to show you a paper. What happened to my files? Oh, this only shows PowerPoint. Uh-oh. So I don't think I can show that. But we did a test on using the PIMCO money market versus the S&P over the last 15 years. Over the last 15 years. And the Sharpe ratio on the S&P was 7.17. The Sharpe ratio on the PIMCO was 0.21. So higher return, lower volatility over a 15-year period. Then we substituted the PIMCO money market with, and I'll send you the paper. We substituted the PIMCO money market with PIMCO total return index. Yeah, Tom, just give me a moment and I'll be done. Over the last 15 years, the S&P was S&P was Sharpe ratio was 0.17. The 90-10 strategy had a Sharpe ratio of 0.57, 324% times better with total downside protection.